Hello and welcome to Forex Academy, your #1 website for Forex and crypto education and analysis. In today's edition, we're going to be discussing how Brexit is finally done, and we're now for the Gbpusd. After 4 years of wrangling over a future trading arrangement between the European Union and the United Kingdom, which left the EU membership back in June 2016 by way of national referendum, a free trade deal has been agreed between the UK and EU on Christmas Eve 2020. The markets will be grateful for a breather in the now finalised divorce, which has finally been settled after years of will they or won't they get a future trading deal completed in time before the UK was forced to end the transition period on WTO trading regulations, which was seen as potentially very bad for the British economy. As many had predicted, the negotiations went down to the wire, and an agreement was set in place with hardly any time to spare. The referendum, which took place on the 23rd of June 2016, where the British people voted to leave the EU, caused the pound against the dollar to crash from 1.47 to a low of 1.21. This happened while the markets tried to decipher how this might play out for the British economy. The pair rallied up to 1.42. In April 2018, as hopes were raised of a negotiated free trade deal, they were soon dashed, and we had the crash to 1.16 in March 2020 as the pandemic gripped the United Kingdom. The pair has been rallying up to its current position at 1.36 at the time of writing, based on the market anticipation that a free trade arrangement would be reached. This extremely bumpy road has been smoothed by the free trade agreement, but what now for the British economy and the pound, as it's finally going its own way as an independent nation? There is no doubt that the bulls are in control for the pair at the moment, and some institutional traders will be looking for the previous highs as shown here on the chart of 1.42 and 1.47. However, the factors to consider are that the free trade agreement only takes up 20% of the British economy, with the remaining 80% of gross domestic product being attributed to financial services, which does not form a part of the agreement, and which still has to be negotiated between the EU and the UK. It is unlikely that the issue in this sector will cause a major upset. However, there is potential for a spanner in the works should the two sides diverge from current alignments in trading standards. The other critical component, which will have an effect on the pound, is the United States Dollar Currency Index, or DXY, which measures the dollar against the most commonly traded currencies known as the majors, and this includes the British pound and the euro. The dollar index has fallen from a high of 103.00 in March 2020 to its current level of just under 90.0 at the time of writing. The Federal Reserve and the United States government implemented stimulus measures by pumping more money and more dollars into the system. This was to shore up the failings of the US economy, which is still in the grips of the pandemic. While traders wonder if cable has run out of steam at 1.36, traders will also be wondering if there is further room for a continued slide in the dollar index, perhaps down to the 88.0 level. As the markets open to a new year and its first new quarter, institutions and investors are adjusting their portfolios for the new financial year ahead. On a market sentiment basis, a fundamental basis, and on a technical basis, it would appear there is scope for a push higher in cable to reach some of the previous levels mentioned at 1.42 and 1.47, especially while the US dollar index is generally under pressure. If you enjoyed the video, then please like and subscribe and leave a comment down below about anything you would like us to discuss in future, or if you have any questions about this particular video. Have a great day.